Hello, Diamond Nesting members. I hope you're healthy and well. Earlier this month, I asked our member community to please let us know any top-of-mind questions, concerns, ETFs, and/or funds that you would like us to talk about in the coming months. Well, it seems that for those who completed this questionnaire, Bitcoin was one of the topics that came up most frequently. And I guess this should not be too much of a surprise. Crypto is sometimes seen as an inflation hedge, and I know that some of our Diamond NestEgg regulars have become increasingly concerned about the reliability of the BLS data that underlie our TIPS and I bonds, especially in light of the recent firing of the head of the Bureau of Labor Statistics. Not to mention, Bitcoin showed quite a stellar performance over the past 12 months. It's up 105%, more than double where it started at the beginning of the period. And just this Wednesday, Bitcoin reached a new intraday high of $124,529 before falling back again a bit for the rest of the week. Compare this to the S&P 500, which is up only a bit more than 18% over that same time. Now, don't get me wrong, 18% is still a very good run. It's just not as strong as Bitcoin. Bitcoin's recent performance, its potential use as an inflation hedge, together with the public support that President Trump and his administration have been giving to cryptocurrencies more generally, seems to have prompted quite a few of you in our member community to start thinking about whether you should put your toe into thus far uncharted waters, so to speak, and potentially add some Bitcoin or other cryptocurrency to your portfolio as part of your alternative asset allocation. Now, cryptocurrencies can be one of those hot button topics that tend to polarize our fellow Americans these days. Some love them passionately, some hate them with a vengeance, and many are just not sure how to think of them and what they're really good for. And that's before we even start talking about the official Trump meme coin that President Trump himself launched on social media a few days before his second inauguration. But here's the thing, as with many other topics in life and money, whether you love crypto or whether you hate it, there's really nothing that can be truly understanding it so that you can make an informed decision, especially since it seems that we may be hearing quite a bit more about this topic in the coming months and years. So, as we normally do here at Diamond NestEgg, let's take a look at the facts and see if this will help some of you decide whether Bitcoin or some form of it may be a potential next step for you, or not. Please also note that for the purposes of this video, we will focus on the key arguments for and against investing in cryptocurrencies, and especially Bitcoin. This will not be a primer on how cryptocurrencies work, nor will we delve deeper into some of the more colorful stories that are circulating in crypto land, such as whether the legendary founder of Bitcoin, Satoshi Nakamoto, was even a real person. Although, if there is any interest in these topics, do drop a comment below and let us know, and perhaps we can discuss them another time. With that in mind, here are the 3 topics that we'll be covering in today's member video. 1. What is the case for and against investing in Bitcoin? 2. How can you get exposure to Bitcoin? And this section is particularly interesting because how you invest in crypto matters not just in terms of risk versus return, but also in terms of whether your investment is SIPC protected. And 3, would we invest in Bitcoin? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, members. What is the case for and against investing in Bitcoin? When people hear cryptocurrency, they often think Bitcoin, and that's not entirely wrong. Bitcoin was the first modern cryptocurrency when it launched on January 3rd, 2009, and it still dominates the market today. At the time of this taping, Bitcoin's market cap of about $2.4 trillion is about twice as big as the market cap of the next 9 cryptocurrencies combined. So given this dominance, we'll focus mostly on Bitcoin in today's video. Here are the top 5 reasons for investing in Bitcoin. 1. Bitcoin has a strong long-term historical track record. Keeping in mind that past performance is not indicative of future results or events, this and the corresponding hope for continuing high returns in the future are probably the main reasons for why most folks are interested in Bitcoin. Bitcoin is up an almost incredible 51,600% over the past 10 years, while the S&P 500 Total Return Index, which assumes you immediately reinvest all dividends, is only up about 290% over the same period, according to Yahoo Finance. 2. Bitcoin is a finite commodity. The way its underlying software has been programmed, only 21 million digital Bitcoin will ever be created, or mined, as the crypto industry says. At the time of this taping, almost 20 million Bitcoin are already circulating, so there can only ever be 1 more million coming to the market. Bitcoin supporters point to this hard-coded scarcity when they defend Bitcoin as a stable store of value and hedge against inflation, especially in comparison to the dollar or, frankly, all other national currencies that can, at least in principle, be created at will and in unlimited amounts by the central bank. 3. There is increasing regulatory clarity and support. I mentioned this already at the beginning of this video. The current administration is gradually opening up the financial system to cryptocurrencies and putting a regulatory framework in place, which should help its mainstream adoption. 4. Bitcoin offers portfolio diversification. Even if you're not strongly invested in Bitcoin, a small allocation within a portfolio may diversify your risk. In this context, most financial professionals would consider Bitcoin part of the alternative assets category. 5. Bitcoin is decentralized and has global reach. Unlike traditional currencies, Bitcoin is a decentralized peer-to-peer asset that is not controlled by any government or other institution. Traditional currencies are always dependent on the central bank, and if cashless, on commercial financial institutions. Bitcoin, on the other hand, is completely yours once you download a coin into your personal wallet, on your hard drive, so to speak, at least in theory, because of course, in real life, most owners of Bitcoin will still own them indirectly via a bank or other financial institution. More about that later. So, now that we've covered these top 5 reasons for investing in Bitcoin, let's take a look at the top 5 reasons that speak against investing in Bitcoin. 1. Bitcoin is volatile. The same chart that showed you the overall strong performance of Bitcoin over the past 10 years also shows you the sometimes extreme volatility along the way. For example, Bitcoin lost about 3/4 of its value between December 2017 and January 2019, and then again between October 2021 and December 2022. 2. There is a lack of intrinsic value and practical applications for Bitcoin. Bitcoin is currently used more for speculation than for actual business transactions. Also, unlike official national currencies, no one has to accept Bitcoin as payment or for any other purpose. Now, there are a handful of sellers like Shopify, which have started testing payment via cryptocurrency, but these offerings are entirely voluntary and they are the exception rather than the norm. 3. The regulatory environment is by no means certain. Yes, the current administration is supportive of cryptocurrencies and has been working on creating an accommodative regulatory framework. However, the previous administration was much less welcoming, and who knows how future administrations might approach the topic. 4. Security and fraud risks remain. As I touched upon earlier, Bitcoin is in principle not dependent on anyone else if you download it into your personal wallet. However, for most Bitcoin holders, that's more theory than real life. Most investors will not have the inclination nor the technical skills to manage their Bitcoin by themselves. So most users will still depend on some type of account with a financial institution. And as many of us will remember from the sudden collapse of FTX, some parts of the emerging crypto ecosystem may not be as mature yet as the traditional, heavily regulated financial system. And that's before we mention the scams and fraud and potential criminal uses of Bitcoin around the fringes. 5. Bitcoin is not great for the environment. This may not be a decisive factor for everyone, but some are concerned that Bitcoin mining uses large amounts of electricity. And there you have it, Diamond NestEgg members. The top 5 reasons for and against investing in Bitcoin. Keeping in mind once more that past performance is not indicative of future results or events. Yes, Bitcoin could keep going up, but it could just as easily come plummeting down again as it has done so in the past, for example, if a less crypto-friendly administration is elected in the future. But let's say that you come to the conclusion that you may indeed want to start dabbling in Bitcoin, or Perhaps you're just curious about all the new and emerging Bitcoin offerings that are coming to market. The next question is, how can you actually invest in it? Bringing us nicely to the next section of today's video. How can you get exposure to Bitcoin? There are really three ways for a retail investor to get exposure to Bitcoin, if you're so inclined. 1. You can buy Bitcoin directly via a broker or some of the younger crypto exchanges that have sprung up in recent years, including Robinhood, Coinbase, and Kraken. These are usually online oriented and offer a wide variety of crypto-related products and services, even beyond Bitcoin. Coinbase, for example, supports more than 250 digital assets, covering major coins like Bitcoin, Ethereum, and XRP, to numerous smaller ones. And for what it's worth, Bitcoin can be transferred in fractions as small as the 8th digit behind the decimal, which is equivalent to about 0.12 cents at the time of this taping. This smallest unit of Bitcoin is called a Satoshi, after Bitcoin's legendary founder, and 100 million Satoshi make up 1 Bitcoin. If you want to stick with a more established broker, Fidelity is the one leading brokerage firm that offers Bitcoin right now via their Fidelity Crypto account. Fidelity's cryptocurrency offering is generally more restricted than for the more specialized newer firms in terms of products and services offered, and you must be a U.S. citizen over the age of 18 and reside in a state where Fidelity digital assets can serve customers. As far as we could gather, Schwab and E-Trade do not currently offer direct Bitcoin investing, but are planning to do so in the near future. And depending on your personal view of crypto, you could say that Vanguard is a fair bit more conservative in the space, or perhaps even skeptical. According to the official statement on their website at the time of this taping, Vanguard's take: since cryptocurrencies are highly speculative in their current state, Vanguard believes their long-term investment case is weak. They do keep the back door open, though, towards the end of this paragraph, stating that as cryptocurrencies become increasingly mainstream, they'll continue to monitor their development and discern the best path forward for their investors. Now, when you buy Bitcoin directly in this manner, please know that it is not SIPC protected, meaning, for example, that if you have an account with Coinbase, or even if you have a Fidelity Crypto account, and either one of these firms goes bankrupt, and your crypto holdings are missing and nowhere to be found, the SIPC will not come in and make you whole up to their standard protection limits, because direct holdings in crypto are not SIPC protected, which is a nice segue into the second way for a retail investor to get exposure to Bitcoin. You can invest in an ETF that holds Bitcoin. Bitcoin ETFs, as their name suggests, hold a portfolio of Bitcoin, are registered with the SEC and listed on a U.S. exchange, so they're generally easy to access and trade. Even better, Bitcoin ETFs, like all other ETFs, are SIPC protected if held in an account with an SIPC member firm. That said, like any ETF, they usually charge a fee, and they do not give you direct ownership of the underlying assets. By far the largest and most established is BlackRock's iShares Bitcoin Trust ETF, or IBIT. It started trading on January 11th, 2024, the first day this was allowed for spot or cash Bitcoin ETFs, has total assets of $87.7 billion, and charges 0.25% expenses at the time of this taping. Since its launch, it has tracked the Bitcoin price quite closely, even though not perfectly, as you can see here. Fidelity's Wise Origin Bitcoin Fund, or FBTC, is next on our list. It started trading on the same day as IBIT and charges the same 0.25% expenses, but is smaller at $24.1 billion. A third Bitcoin ETF is from a newer firm that specializes in managing cryptocurrency and other digital assets. The Grayscale Bitcoin Trust ETF, or GBTC, was basically converted from a trust structure that had been established in 2013 to an ETF in January 2024. According to Morningstar, GBTC has $21.3 billion in total assets, only slightly behind FBTC, but it does not come cheap with an expense ratio of 1.5%. And maybe this high expense ratio is the reason why Grayscale also launched the Bitcoin Mini Trust ETF, or BTC, in July 2024. BTC is essentially a spin-off from GBTC, but it is significantly smaller with only $5.5 billion in total assets. And it only charges a tenth of the expense ratio of GBTC at a mere 0.15%, even cheaper than IBIT and FBTC. There are more Bitcoin ETFs on offer, but BlackRock, Fidelity, and Grayscale really seem to dominate the market with a sizable gap to the next followers. Moving on now to the third way to get Bitcoin exposure. You can also invest in instruments that add one or two additional layers of financial engineering on top of the underlying Bitcoin risk. In my mind, this is for investors who either really believe in or wish to speculate on Bitcoin. This additional layer or layers of financial engineering, think leverage and or derivatives, are meant to increase the potential for extra returns, but they always add corresponding risks as well. Two of these more complex instruments that are relatively well known are MSTR and MSTY. MSTR is the Class A share of Strategy Incorporated, previously known as MicroStrategy. The company calls itself a Bitcoin treasury company and essentially uses leverage, buys additional Bitcoin with borrowed money to boost the upside in good markets, which on the flip side makes bad markets even worse on the way down. At the time of this taping, MSTR's trailing one-year return is an impressive 186.06% on the back of a strong year for Bitcoin. MSTR does not pay a dividend, however. MSTY is the Yield Max MSTR Option Income Strategy ETF. This fund has the main goal of generating distributable income for its investors by writing options, mainly call options, on the same MSTR shares of Strategy Incorporated that we just discussed. At the time of this taping, MSTY shows a trailing one-year total return of 122.75%. This is the total return an investor would have made from an investment over the past 12 months, including dividends and capital gains or losses. MSTY's 12-month distribution yield is even higher at 147.21%, and this latter number is essentially what they paid out in dividends over the past year, which probably explains why it has attracted quite a bit of interest in our member community and some online forums. That said, if you did the numbers in your head and are thinking, but wait, Jen, how come the distribution yield is larger than the total return? Doesn't that mean that MSTY paid out more in dividends than the share returned and was worth over the past year? Well, that's exactly what happened. MSTY paid out more in dividends than the share was worth. And on top, the share price of MSTY was down over the past 12 months. You could almost say that the high cash payouts ate into the substance of the investment, so to speak. And this decay, as the industry calls it, is another sign in my mind that MSTY is more for short-term speculation than for long-term investments, by the way. So, to repeat it once more, the triple-digit historical returns of MSTR and MSTY can look very attractive, to put it mildly, but they are higher risk than buying Bitcoin directly here and investing in an ETF that holds Bitcoin here. Some would even say that MSTR and MSTY are much higher risk. Both MSTR and MSTY have Bitcoin as their fundamental underlying risk. With MSTR, you add leverage risk on top of Bitcoin risk. And with MSTY, you have the underlying Bitcoin risk plus the leverage risk from the MSTR stock, and then you add options risk on top. So MSTY basically exposes you to three not insignificant pools of risk in my mind: Bitcoin risk plus leverage risk plus options risk. As I often say, one of the fundamental pillars of personal finance is high risk, high return. Now, MSTR and MSTY are very complex, and we will actually have a separate video coming out very soon on them because of all the questions you've sent our way on these two. So if you're interested in learning more about them, stay tuned for that video. For today's video though, and now that you know the three ways that an investor can get some Bitcoin exposure, if they're so inclined, let's move on to the next part of today's video. Would we invest in Bitcoin? Personally, Bitcoin is not for us. Not now anyway. Yes, it has had a great run, especially recently, driven both by the approval of Bitcoin ETFs under the Biden administration and then by the additional support from President Trump and his administration since then. But its volatility, lack of intrinsic value and practical use, ongoing uncertain regulatory environment, and security and fraud risks are significant enough reasons for me not to hold any of it in my portfolio at the current time. The day-to-day and week-to-week ups and downs in the stock market are as much as I'd like to have on the risk side of my portfolio. That said, everyone's financial journey is different, and I could see a case for holding Bitcoin in your portfolio if you have a strong conviction about its future success and or find these top 5 reasons for investing in Bitcoin compelling enough to at least dabble a bit in it. But even if this is you, here are my 3 golden rules for Bitcoin investing to keep in mind. 1. Educate yourself first before you start your Bitcoin journey. Bitcoin is new and unfamiliar to many investors. It's not like adding a new equity or bond fund where you probably know the risks and how it works in principle. Invest enough time to understand at least the fundamentals of Bitcoin and its specific risks. Today's video is only meant to be a first overview. 2. Make sure you can handle the volatility and never invest more than you can afford to lose. In fact, if it were me, I would not pencil in any future returns, but rather be prepared to lose some, or in the worst case, all of my initial investment as well. As we discussed before, Bitcoin has already seen at least 2 prolonged stretches with losses of around 75% from peak to trough between December 2017 and January 2019. And then again between October 2021 and December 2022. If you're someone who loses sleep or heads for the exit when markets drop significantly, you may want to think twice before jumping into crypto land. 3. Start as simple as possible. If you decide to invest in Bitcoin, it may make sense to begin with a spot or cash Bitcoin ETF from a trusted asset manager, such as IBIT or FBTC. Personally, I think that these are easier to understand, access, and trade for a Bitcoin beginner. Plus, they are protected up to the standard levels in the event that your SIPC member broker were to go bankrupt and your securities were to go missing. And only if you have the stomach and knowledge for it, then you may want to consider exploring a direct investment in Bitcoin, which again is not SIPC protected, or more complex and leveraged products such as MSTR and MSTY. And on that note, I will leave you with the message that Fidelity displays prominently and repeatedly on its crypto pages. Crypto is for investors with a high risk tolerance. Investors could lose their entire investment. Do drop a comment below though. What other crypto questions do you have? And if you're planning on picking up some crypto, what will you be buying? Or are you taking a wait and see approach for the time being, like we are? All right, super savers, I hope you enjoyed today's member video and learned something new about Bitcoin. And for those of you who are interested, stay tuned for the separate video on MSTR and MSTY that some of our members have requested. It will be posted to our public channel shortly. As always, we appreciate you and see you again very soon with more brand new wealth building content for your financial journey.